Kenneth says, what do you think of the wheel strategy? Well, I haven't read the whole approach, okay? And I've read some of the articles that are out there. I've read some of the, there's a gentleman, I think, on Seeking Alpha that every week posts his trade he's doing on Tesla with the wheel. I forget the gentleman's name who's following his trades about how he's rolling the puts or when he got assigned and what covered call he's doing and so forth, Kenneth. To me, the wheel strategy, I just started hearing this term in the last 6 months. Okay. And someone on YouTube had mentioned, what, you've never heard of the wheel strategy before? It's one of the most common things ever used. The reason I've never heard of it is because when I first started working with Ernie, and Ernie's never heard of it called this either until they started advertising the book, quote unquote, the wheel strategy. It was a common approach from what we can see. I mean, he's the person who authored the book and is doing the wheel strategy probably has trigger points and criteria, and it's probably well thought out, and he's been doing well with it. That's fine. I know some investors are doing well with it. That's fine. But to us, it's simply what we were just talking about. I'm selling a naked put on a stock that I'm neutral to bullish on to get some premium. What are the risks? I don't have a lot of downside protection here. That's where the triggers probably come in if there's a sudden decline, plus the criteria for the stock selection so that you're looking for positions that probably aren't as volatile, have a small out of the money income for 30 days, 1.5% maybe on the short put, maybe a little bit higher, but there's triggers there to adjust the position if it's moving against you. Maybe roll down the put, maybe not. I think in most cases, the idea is if the stock falls, we just take assignment and we convert it to a covered call, as long as it's still profitable to the upside, depending on how steep the decline was. This has just been a common approach by investors. I have a gentleman that's been with power options for years, longer than I have. And I talk to him maybe once every 6 months. He just calls in to see how things are going or if he needs to update his credit card. And he's right up here in Pennsylvania. 90% of his portfolio is naked puts. His cash secured naked puts, and if it gets put to him, he just converts it to a covered call until it gets assigned, and he just keeps doing that. I don't know how different his approach is from the wheel, but since about 99, he's been doing this and using power options to find positions and track them, takes a break here and there. Sometimes he goes on a summer vacation. But the idea, Kenneth, is that it's just a common approach as far as I can tell. Selling a put option to get into the stock at a discount or to have it expired. If it expires, hey, you sell another put against it, keep following the stock up. That expires, hey, we're up to the 27 range. Maybe we're selling at 25 now. That's fine, just getting premium. And if it does come down and get assigned, great. You've got premium in, you've got a lower cost basis. Now you convert it to a covered call. And I don't know if they roll the covered call if it goes up a certain amount or if they just let it get assigned and then open a new position. It's a common approach used by a lot of investors, but not necessarily has to be the wheel. All right. It's just selling puts that your stocks you're bullish on that you wouldn't mind owning. And if it gets put to you, you convert it to a covered call. I don't know the whole ins and outs. I don't need to buy the book to go ahead and see what they're doing with all of the criteria they're selecting and what are their stops, if any. What is their decision-making process to allow the put to be assigned to convert to a covered call or maybe just to close it if the sentiment has changed. It's just a common approach that's been used to, hey, let's get some income with naked puts. And if we get assigned, we just convert it to covered calls because we're long-term bullish on the stock or we want to have it as a as a core holding in our account as well. Okay. And Brent says, what was the name of the book? I don't know. I see it on Facebook ads when I go on Facebook. Mark H. Can't remember his name. I think it's just called The Wheel Strategy as far as I know. And I don't even know if that's the most popular one. I think there might be 2 or 3 other books out there that discuss it. And it's not expensive. Don't get me wrong. It's just, this is a common approach. And I did this for 2 years, probably in 2005 to 2006, I think. I got bored with covered calls. I was just doing covered calls. I got a higher approval rate. And so I started doing naked puts, debit spreads, and long collars. And I was more successful with the long collars than I was with this approach, but that's not every market. That could have just been the current market conditions in that case. Okay. So that's my thoughts on that related to the wheel. I don't think it's a bad strategy. It's a common strategy that investors use. Yeah, I can't remember the name. Marcus, Chuck says, it's not Mark, it's Marcus Heitkoetter, Heitkoetter. Okay. So that's the quote unquote wheel strategy approach. And it's just a common approach used by investors. And someone, was kind of astounded. I think it was a YouTube comment. He was amazed. I think he literally said, "You call yourself an options educator and you never heard of the wheel strategy." Because I've known probably 300, 400 people that do this. And I've had coaching sessions with them on power options over the years. Never one of them referred it to as the wheel strategy. They're just selling naked puts, and if it gets assigned to them, they convert it to a covered call. It's as simple as that. So let's see here. Ben, I'm going to take your second question now. You said a covered call is considered the most conservative trade. What is another conservative strategy? Let's be honest. Covered call is called a conservative strategy by brokers. And and Chuck also adds this. I'm sorry, Ben, I'll get to yours in just a moment. Chuck also adds this. It's just a fancy name to sell books, and that might be true too. But I'm not going to state that because I'm sure he's doing it right, and he's doing it in a way to keep people safe. Again, not looking for highly volatile positions. He has a trading plan in mind to keep the investors who follow that strategy relatively safe with a naked put. But back to Ben's question here. Covered calls and naked puts. I'm sorry, yeah. We just looked at a naked put position, an out-of-the-money naked put, which is a parity trade to an in-the-money covered call. They have the exact same risk-reward profile, potentially the same return. Ben says a covered call is considered the most conservative trade. Not by us. Not by a long shot. Okay? It always frustrated me in the beginning, and around 2008, we partnered up with Kurt Frankenberg, who wrote the original edition of the Blueprint with the married put, why brokers still only allowed on level 1 to do a covered call position, where you buy stock, you sell a call against it, okay? You get a potential for a good return on the position. If the stock ramps up 10, 12, 15%, you only make 3. You get assigned, or you have to pay a lot to roll the position, Ben. But if it falls 12, 15, 20%, you're still on the hook for a 9, 10, 11% loss on the position. Okay? Lie of leverage. If I have a 10% loss, do I need an 11? I'm sorry, if I have a 10% loss, Ben, do I need a 10% gain to get back to break even? No. I need 11.1% on what I have left. If I have a 20% loss, I need about a 28% gain. If I have a 25% loss, I need a 33% gain on what I have left in the position. Covered calls, naked puts, cash secured puts, leave the downside open. Now, if I go in the money with the covered call, I have some downside protection. I have some premium in that case to give me, I'm sorry, I'm in the money, so the stock can fall before I'm at break even. I've got some premium in that case. Am I in the money here? Yeah. So Marathon Patent Group, stock at 49.46, a weekly trade selling the 46.5 strike, potential return if assigned of 2.5%, and a downside protection of 8.2%. Stock needs to fall 8% before I'm technically losing money on the position. Or if I went right at the money for a higher return, instead of selling the in the money covered call position, we sold an at the money at around 50. We're going to get a lower premium, but it's mostly going to be higher time value, higher extrinsic value in that case, Ben. And I might be looking at a 5 or 6% return, but now I'd probably only have a 4% or 3% downside protection. If you're in a bullish market, you might consider this conservative. Just look at the profit and loss chart without even thinking of this as a covered call. I'm looking for the potential to make 2.5%. Yes, that's in a week, but in general, let's just say I'm looking to make 2.5% here with the potential to maybe lose $1,400, $1,500 if the stock falls to 30. Is that a good risk-reward ratio? You say, oh, but I'm going to be right 70% of the time. But if you take one of those losses that's 20, 25% down, that's going to wipe out 10 to 12 previous wins. You're behind the 8 ball. Now you've got to play catch up. Okay? That's the experience I had with covered calls, which is why I converted to standard collars after a short time, right around 2006, as I mentioned. This was the October 29th. And so the collar, yeah, it's going to take away some of the potential premium and some of the potential profit. And I wouldn't do a collar this way, so just ignore the fact that we have an in-the-money call here. But again, yeah, so if I set up a collar, I'm usually looking to make 3%, but not risking more than 4 or 5% on the position for a 20 or 30-day trade. It's guaranteed. It's peace of mind. What can't you do on level 1 trading once you first apply to options? You can't do the collar spread. Let's look at a proper collar here. A marathon at 49.46, it'd probably go out 20 days, 14 days. I'm going to sell the at the money 50. And yeah, I like that. I'm going to buy the 45. So I'm taking half of the premium away. Why? Because if I'm assigned, I can still make 4.9%. And if the stock craters down below 45, it's more than a 10% decline. Most I can lose is 5.6%. But you can't do this on level one trading. Isn't this more conservative than a covered call? I'm guaranteed not to lose more than 4 or 5%. And I still have the potential to generate premium and make 4.9% on the position. Why wouldn't this be allowed on level one to keep investors safe? Brent says, as a former FA, firms think that because you have the underlying stock, that makes the covered call strategy conservative. And he's right. Okay, meaning that you're not selling a naked call, which is a bearish position anyway, but you have the security underneath of it, where if the stock falls 10%, you might only be down 7. If the stock falls 12%, you might only be down 9. Okay, but if it falls 20%, you're still going to be down 17. And that's wiping out 6, 7, 8 previous trades of the return you're making, Ben. The long collar is one of the most conservative strategies that you can do, more than a covered call or cash secured naked put. Even though I could go out of the money, 5, 6% out of the money on the naked put and take in that 1% premium. That means the stock can fall 7, 8% before I'm hitting break even. How often does that happen? Not often. You're avoiding earnings and you're not taking too volatile a stock. Then again, I'm very happy I did not do a covered call on Ally Financial when it hit its peak at 56 right before earnings. I'm very happy I did not do a cash secured put or a bull put credit spread on Ally Financial. I was very happy that I was in that married put position, which had no risk. And if I had opened a married put right before earnings on Ally Financial, I would have bought stock at around 56. I probably would have bought a 60 strike put, probably out to June. And at that time with the stock at 56, I'm going to say it's probably has only been 770, 780. We'll use 8. Okay, that's about right. Okay, so now the stock's declined, and here I am. The stock we saw fell down 10%. I'm probably only close to a 6.3% loss. Actually, it's much less than that. It's probably only 5%, half of the loss. The married put structure, the way that we teach it in, again, the blueprint, with the proper structure, putting time on your side and the controlled risk, in this case, to me is the most conservative option strategy you can do. Instead of the covered call with a capped upside and lots of risk to the downside, we have a capped downside that's guaranteed, better than a stop order. You do a covered call and you put a 7% stop order, stock falls 20% overnight, you don't get filled at the 7% stop. You get whatever the market can give you at the open. You're down 20% on that position. Closing the call, selling to close the stock, okay, maybe you're only down 18%. If that happened to me in this case, the most I could lose was 6.3%. And let's add it to the portfolio with those numbers. Just put it in here, radioactive one. All right, and submit that. Okay, and where am I? Here's my 60 put on Ally Financial. Stock is down 9.5%, close to 10%. Look at that. Only down 2.7% on the married put position. The put is out so far. It still retained most of its extrinsic or time value in that case. Yeah, it's close to intrinsic now, but it still kept its time. Even with the stock down 9.5%, I'm only down 2.5%. If the stock had moved up 9.5%, would I make less than that because of the put? Yeah, I'd still make about 50 to 60% of the gain in the price. So if it moved up 9.5%, I might be at a profit of 5.5 or 6%, higher than what I would have had with a covered call that would have only given me 3% for 1 month out trade with buying the stock at 56. Okay, if I sold to 60, maybe I'd get a higher potential, but that would be the intrinsic gain. But if I bought the stock right at 55 and sold the 55 call, even around earnings, that was only a 3% return for 30 days. I missed the rest of that 9.5% gain. Think of the math and think of the structure. Stock falls 10%, you're only down 2 or 3%. Stock goes up 10%, you're still up 5, 6, or 7%. Isn't that a better win-loss ratio than a covered call position We're looking to make 3% if you're right, or 2.5% to the upside if you get it right in the maximum return, while still taking 97% of the whole risk of just owning the stock by itself. Okay? All right. And yeah, I mean, we advocate the married put every time, almost every time on the webinars. Bennett added, thanks. I'll look at that. I've had a few stocks crater on me. It would have been nice to have that downside protection. Kenneth.to, for example. Hey, Ally, I'm very happy I was in a married put on that position. I am still bullish on it. I think it's going to recover. It just might take more time. I'm going to digest that, but I'm just going to hold it for 8 more days to get that extra dividend that comes out. And then I'll decide I might just close the position, still have a profit even with the stock down. Most conservative strategies, the long collar, as I mentioned, and the married put. And if you go to the married put or the long collar section, you'll see here some basic introduction strategy help. Where's Ernie's 4-part article here? The covered call challenge, limited risk solution. These are all just white papers. Married put and collared strategy. The sketch is the introduction to the blueprint. It's a 9-page white paper, Ben, that introduces the concepts.